The Indian stock market is on a roll with no signs of slowing down. Despite the sharp surge, retail investors are not shying away from the markets. Instead, they are using every small dip either to make fresh entries or further bolster their portfolios. This is evident from the recent data releases as well. Data from the Association of Mutual Funds in India, or AMFI, shows that net inflows into equity mutual fund schemes shot up by a whopping 17% month on month from May to June, hitting a record-breaking 40,608 crore rupees. The net assets under management of the mutual fund industry crossed the 60 lakh crore mark rupees for the first time to hit 61.6 lakh crore as on June end. Even more impressive is the contribution from systematic investment plans, or SIPs, which hit a record high again of rupees 21,262 crore in June, and this is up from 20,904 crore in May and 20,371 crore back in April. These numbers tell a clear story. Investor confidence is surging and the equity markets are thriving like never before. Market watchers say new investors are comfortable putting in money at current prices despite a general perception that valuations are expensive. Two key factors are driving this surge. First is the fear of missing out, of FOMO, as markets continue to hit new highs. Second is the belief that any market correction is a chance to buy at lower prices. Now, this is creating a positive feedback loop where more money flowing into the market is pushing the stock markets higher, which then attracts even more investors, so on and so forth. And so far, this strategy is paying off. Last week, the Sensex hit the 80,000 mark for the first time, recording nearly 11% returns since June 4th, the day of the election results. In 2024, so far, the 30-share index and the Nifty have gained about 11 to 12%, while the mid-cap index has jumped an impressive 23% and the small-cap index has risen almost 24%. But amidst all this exuberance and excitement, we must take note of the subtle yet significant changes on Dalal Street that are flashing signs of an aging bull market. For instance, this year, fewer stocks have driven the Nifty, mid-cap, small-cap indices compared to last year. In case of the 50-share Nifty, just 10 stocks led by Reliance Industries and Bharti Airtel contributed to 73% of the nearly 2,600-point gain in the index. A similar trend was seen in the broader market as well. In contrast, a wider set of stocks drove these indices last year. What does this backdrop mean for investors? It suggests that caution might be warranted. With fewer stocks driving the market, the rally could be more fragile than it appears. Investors should be vigilant and consider diversifying their portfolios to mitigate risk. It's also a good time to reassess investment strategies, ensuring they are aligned with long-term financial goals and not just short-term market trends. As always, maintaining a balanced approach and staying informed will be key to navigating these evolving market dynamics. And remember, in the world of investing, sometimes the best move is knowing when to step back and watch the game unfold.